Santok is a retired person and he derives his income from his pension as well as some FD income. And he's in a 30% tax bracket. And he wants to know what options would he have other than ELSS. So broadly, do you have any specific advice for taxpayers who are senior citizens?
Yes, one important thing is that he tax save is money earned, and for somebody who is on this in this age bracket and this income profile where uh, he cannot look to significant upside. One important thing for most such investors is that you should derive as little money from fixed income avenues, because all the returns that you derive by way of interest is always looked upon as is treated as income. But if your return somehow gets converted into capital gains, it is treated in concessionally. For example, even in a debt fund, if you are deriving exactly the same return as you do in a mutual fund, by virtue of holding it for over 3 years, post indexation, 20% tax rate on the gains after indexation will be a far lower rate as compared to a 30% tax on all the interest that you'll be deriving. So, one is this. The other is that the amount of money which you don't require, you should put that money into equity or in hybrid, more conservative vehicle, and you should invest in the growth plan so that you are able, you can be methodical about it. You can actually plan when you want to derive that income as and when you need it, and not take that income when you don't want to. So the kind of flexibility, so I would say that consider the growth plans of the monthly income plans. It's a conservative vehicle, they just have about 15-20%. First, consider the debt fund, as much money that you can put there. You will derive similar return as fixed deposit, but you can plan the outflow from it in a manner which will be more tax efficient. Then consider these MIPs, and if you don't need the amount of money that you income every month, then simply reduce your income by putting money as much money in balance fund. There the money will grow faster, better, and all the returns that you will derive post holding for over 1 year will be completely tax free. So it will require little planning, but it is not a very complicated planning. Just work on your cash flows, amount that you want to derive, and make your allocation accordingly.